For our first subtopic, we will be finding the initial investment. First off, we will start off with what is initial investment. It is the amount required to start a business or a project. It is also called initial investment outlay or simply initial outlay. Example number 1. Sandra Copper Company Ltd. SCCL started a copper and gold exploration project in Balochistan in 2005. In 2006-2007, it incurred expenditures of 200 million on seismic studies of the area and 500 million on equipment, etc. In 2008, the company abandoned the project due to disagreements with the government. Recently, a new business-friendly government is sworn in. SCCL Managing Director believes the project needs reconsideration. The company's financial analysis and chief engineering estimate that 1,500 million worth of new equipment is needed to restart the project. Shipment and installation expenditures would amount to 200 million. Current assets must increase by 200 million and current liabilities by 90 million. The equipment purchased in 2006-2007 is no longer useful and is to be disposed of for after-tax proceeds of 120 million. Find the initial investment outlay. Okay, so here's the solution for the problem. It will start off with the initial investment equals equipment purchase price plus shipment and installation plus the increase in working capital minus the disposal inflow. Now, for the calculations, you'll have 1,500 million plus 200 million. Now, for the increase in working capital, you'll grab 200 million minus 90 million, which will then give you 110 million for the increase in working capital. Then you'll minus 120 million, and your total then will be the 1,690 million. Now the SCCL needs 1,690 million to restart the project. It needs to estimate future cash flows from the project and calculate net present value and internal rate of return in order to decide whether to go ahead with the restart or not. Now, let's keep in mind that the 200 million expenditures on the seismic studies is not a part of the initial investment because it is a sunk cost. Now we'll talk about the install cost of new assets. The install cost of a new asset is found by adding the cost of the new asset to its installation cost. The cost of the new asset is the net outflow that its acquisition acquires. The cost of the new asset plus its installation cost equals the asset's depreciable value. Now coming back to our solution, we're going to install the cost of the new asset. So the cost of a new asset is 1,690 million plus its installation cost, which is 90 million, and this will equal to 290 million, which is the asset's depreciable value. Now that is how you install the cost of new assets to get your answer.
Hello, my name is Nicole and today I will come to explain after-tax proceeds from sale of all assets. In the table 8.2 show that the after-tax proceeds from sale of all assets decrease the firm's initial investment in the new asset. These proceeds are the difference between the all asset sales proceeds and any applicable taxes or tax reforms related to its sales. The proceeds from sale of all assets are the net cash inflow it provides. This amount is net of any cost incurred in the process of removing the asset. The proceeds from the sale of an all asset are normally subject to some type of tax. This tax on sale of all assets depends on the relationship between its sale price and book value and on existing government tax flow. Book value. The book value of an asset is its strict accounting value. It can be calculated by using the following equation. Book value equals installed cost of asset minus accumulated depreciation. Example, Hudson Industries, a small electronic company, 2 years ago acquired a machine tool with an installed cost of 50,000. The asset was behind depreciated under NICRS for 5 years recovery period. 20% and 32% of the installed cost will be depreciated in years 1 and 2 respectively. In others words, 52%, we can see 20% plus 32%, we can have 52% of the 150,000 costs are 78,000. So we can see how we can get this 78,000 will represent the accumulated depreciation at the end of year 2. Book value equal to 150,000 minus 78,000 equal to 72,000. The book value of Hudson asset at the end of year 2 is therefore 72,000. Basic tax rule. 3 potential tax situations can occur when a firm sells an asset. This relationship between the asset sales price and its book value. In the table 8.3, tax treatment on sale of asset, we can say the form of taxable income that we can say gain on sale of asset and loss on sale of asset. The definition for gain on sale of asset is portion of the sale price that is greater than the book value, and loss on the sale of asset, the definition says amount by which sale price is less than the book value. We can see the tax treatment and the tax rate. Hello, today I'll come to explain the taxable income from sale of assets. So asset initial purchase price of 150,000, this is the initial purchase price, and the current book value will be 72,000, right? So it Hudson sell the all asset for 160,000 for this part. It realized a gain of 88,000. Here it will be the gain. How will get this 88,000? So we must to subtract 160,000 minus 72, the book value, and we will get 88,000. Technically, this gain is made up of 2 parts: a capital gain and recaptured depreciation, which is the portion of the sale price that is above book value, and below initial purchase price. For Hudson, the capital gain is 10,000. Why 10,000? How we can get this? Because we must subtract 160,000 sales price, this one, minus the initial purchase, minus this one. Recaptured depreciation is 78,000. So how we can get this? The 160,000 minus 72,000 book value. So we can get this. So, but the 1,000 capital gain and the 78,000 recaptured depreciation are under the 160,000 sales price. The total right here will be situated in this part. So the total gain above book value of 88,000 is taxed on ordinary income at 40% rate, resulting in taxes of 3,500 to 35,200. Sorry. How we must to get this? We must multiply 0.40 multiplied by 88,000. These taxes should be used in calculating the initial investment in the new asset using the format in the table 8.2. In effect, the taxes raise the amount of the firm's initial investment in the new asset by reducing the process from the sale of the old asset. If Hudson instead sell the old asset for 90,000 for this, it experienced a gain above book value of 18,000. So I show under the 90. So this here, it will be the gain. You see? So because the firm is assumed to be in 40% tax break, the taxes on the 18 gain are 7,200. How we must get this? We must multiply 0.40 multiplied by 18,000. So the sale of asset for less than its book value, if Hudson sell the asset for, we can say 54,000, it experienced a loss of 18,000 as shown under the 54,000 sale price. It will be the loss under this part. If the asset is not depreciable or is not used in the business, the firms can use the loss only to offset capital gains. In either case, the loss will save the firm 7,200. So how we must get this? We must multiply 0.40 multiplied by 18,000 in taxes. And if current operating earning or capital gain are not sufficient to offset the loss, the firm may be able to apply these losses to prior or future years' taxes. So thank you.
Okay, now moving on in change in net working capital. Net working capital is the difference between the firm's current assets and its current liabilities. Changes in net working capital often accompany capital expenditures decisions. If a firm acquires new machinery to expand its level of operation, it will experience an increase in level of cash, accounts receivable, inventories, accounts payable, and accruals. These increase results from the need for more cash to support expanded operations, more accounts receivable and inventories to support increased sales, and more accounts payable and accruals to support increased outlays made to meet expanded product demand. Current assets increase more than current liabilities, resulting in an increased investment in net working capital. This increased investment is treated as an initial outflow. Change in net working capital were negative, it would be shown as an initial inflow. The change in net working capital, regardless of whether it is an increase or a decrease, it is not taxable because it is merely involve a net buildup or net reduction of current accounts. Okay, here is an example of calculation of change in net working capital for Danson Company. So current assets expanded to increase by 28,000 and the current liabilities are expected to increase by 13,000, resulting a 15,000 increase in net working capital.
So here's the table. We have to the left current accounts, and then to the right we have change in balance. So under current accounts we have cash, accounts receivable, inventories, current assets, accounts payable, accruals, current liabilities, and change in net working capital. And then so the first is cash, which is 6,000. And then following accounts receivable, which is 12,000, and inventories, which is 10,000. So you add the three and you'll get 28,000, which is your current assets. Moving on with accounts payable. So your accounts payable is 9,000, your accruals is 4,000. You add them two and you'll get 13,000, which will be your current liabilities now. So you grab your current assets, which is 28,000, minus your current liabilities, which is 13,000. You minus it and you'll get 15,000, which will be your change in net working capital. Moving on to now how to calculate an initial investment. So initial investment is the amount required to start a business or a project. It is also called initial investment outlay or simply initial outlay. It equals to capital expenditures plus working capital requirements plus after-tax proceed after assets disposed of or available for use elsewhere. Okay, so here we have an example of calculating the initial investment. So I'm going to be reading the problem. So the proposed machinery price is $500,000. An additional of 20,000 will be necessary to install it. Depreciation under MACRS using a 5-year recovery period. The present machine was purchased 3 years ago at a cost of 360,000 and was being depreciated under MACRS using a 5-year recovery period. The firm has found a buyer willing to pay 400,000 for the present machine and to remove its buyer expense. The firm expects that a 45,000 increase in current assets and a 20,000 increase in current liabilities will accompany the replacement. These changes will result in 15,000. So 45,000 minus 20,000 increase in net working capital. The firm pays taxes of 40%. The book value represent machine can be found in using depreciation percentage from the table 4.2, which is 20%, 32%, and 19% for the years of 1, 2, and 3 respectively. Okay, so here we have an example of the calculating the initial value. So we have install cost proposed machine, which is cost of proposed machine, which is $500,000, and the installation, which is 20,000. So you add both of them and you'll get your total install cost, which would be $520,000. Then after that, you have your after-tax proceed from sales of present machine now. So which was $400,000. Okay, now you have 180,240, which is your tax on sales present machine. So how do you get that? So to get that you'll do 0.40 times 295,600, which will give you 118,000 with 240. So when you minus the proceed from sales of present machine and the tax of sale present machine, you'll get a total of $281,730. So then after that, you put your change in net worth capital, which we did earlier, we got $15,000. So after that, you do your $15,000 plus. Okay, so you'll add the $15,000 with the answer you'll get, which is total installed cost minus total after tax proceed. So for the total install cost is 520,000, and for the total after tax proceed proceed, is 281,760. So when you minus those two, you'll get 238,240. So after you minus your total installed cost and your total after proceed, you'll then add $15,000 and you'll finally get your initial investment, which will give you 253,240. That will be your initial investment.
Okay. Operating cash inflows. What are operating cash inflows? Operating cash inflows are simply the incremental after-tax cash inflows gained from the implementation of a project during its life period. This is simply money gained from an asset during its life expectancy. What is the formula to calculate operating cash inflows? The formula is operating cash inflows from a new asset minus the operating cash inflows from an old asset, as listed in the example below. $65,000 for the new asset less $50,000 from the old asset, which is a result of $15,000. And after tax, what is after tax? After tax is simply the amount of disposable income a consumer or a firm has after all taxes have been deducted. This is simply money that a consumer holds after he or she or a firm has paid all of their taxes and they have at their disposal.
Interpreting the term cash inflows. All benefits expected from a proposed project must be measured on a cash flow basis. A cash flow basis refers to a major accounting method that recognizes revenues and expenses at the time cash is received or paid out. Cash inflows represent dollars that can be spent, not merely accounting profits. This basically means that it's not about how much profit a company makes, but it's how much revenue a company can generate. There's a simple accounting technique for converting after tax net profits into operating cash inflows. Now, to get operating cash flow, we must first find net operating profits after taxes. To do net operating profit after taxes is just earnings before interest and after taxes and a capable corporate tax. After finding that, to get operating cash flow, you will just add depreciation and other non-cash charges. So as you can see in this table shows the revenue expenses of a company with a machine that they are planning to get and with a machine that they have. So as you can see on the left hand side it said with a proposed machine. So when a company is trying to invest into a new machine, they will want to see how this machine will benefit them in the revenue and expenses section. As you can see, expenses are excluding depreciation and interest. So if a company wants this machine for 5 years, they will estimate with the proposed machine how much revenue they can generate and how much expenses they can generate. So you can see into 1 to 5 years constant. But as you can see on the right hand side, it said with the present machine, meaning that the machine that they have, or which is like basically brand new what they will get. So when they get the machine, they still want it for 5 years, but it shows that the revenue fluctuates and the expenses fluctuates as well. So this table is just basically showing you like how what a company will do when they want to get a new machine. So they will try to calculate if this machine will benefit them or not. So depreciation expense for proposed and present machines for Powell Corporation. As you can see in this table, they show the depreciation and how these machines will depreciate for the following years. what they use is that they use the MACRS depreciation method. So with the proposed machine or the estimated machine, they showed how how many, like in the years, how much money will be depleted from 1 to 6 years. So they initially start with 5 years, but this depreciation method gives you 6. So in the first year, it shows 20%, which the machine depleted by 104,000. And as you can see, at the end of the 6 year, it shows the full amount of what they got it for. Because when a company buys a machine, they do not plan to resell it. They try to deplete it itself, so they want to use it from start to finish. But what you see with the present machine is that when they bought the machine, it already had 3 years of depreciation. So what they did is that they did not start the depreciation rate over, is that they just continued because to be they wanted to be completed out of its life. So what they did is that instead of starting from the first year, which would have been 20%, they started at the fourth year, which is at 12%. As you can see, year 4 depreciation. So they continue at that. As you can see, it only depreciated to 104,400 at the end. So as you can see, this table shows how this machine will be depreciated, and this is how companies will show like how machines are depreciated even if they're new or old.
Table 11.7 Calculation of operating cash inflows per Powell Corporation proposed and present machine. We will be showing how to solve this table. We will begin with the proposed machine. Here we're going to take our revenue minus our expense. Our revenue being 3,540,000 minus our expense 3,320,000. These two are found in table 11.4, our revenue minus our expense. After we minus these two, we're gonna get our earnings before depreciation, interest, and taxes, which is going to be 220,000, and we're gonna minus our depreciation by this. Our depreciation is found in table 11.5 right here, 104,000. So we're gonna minus the earning before depreciation, interest, and tax by the depreciation, which is going to give you 116,000, which is the earnings before interest and taxes. From there, we're gonna find our 40% and minus it. Our 40% being 46,400, and we will get our net operating profit after taxes, which is 69,600. Then we're gonna add our depreciation, which is the same depreciation as here of 104,000, and that's going to give us our operating cash inflows. And same goes for year 2. Our revenue 3,540,000 minus our expense of 3,320,000 is going to give us an earning before depreciation, interest, and taxes of 220,000, and we're gonna minus our depreciation of 166,400, which is going to give us our earnings before interest and taxes of 53,600, and from there we're gonna minus our taxes of 40%, which is 21,440, and that's going to give us our net operating profit after taxes, and we're gonna add that by our depreciation of 166,400, which is going to give us our operating cash inflows of 1,098,560. And we do the same for the following years, for year 3, year 4, and year 5, all the way to year 6. Now we're going to look at solving with the present machine. Here with the present machine, we'll take the same, the revenue minus the expense, which is also found in table 11.4 with our present machine, 3,220,000 minus our expense of 3,010,000. So after we minus these two, we're gonna get our earnings before depreciation, interest, and tax, which is going to be 210,000, and we're gonna minus our depreciation, which is found in table 11.5, which is 43,200. After we minus our depreciation, we're going to get earnings before interest and taxes, which is going to be 166,800, and we're gonna minus our 40% tax, which is 66,720, and that's gonna give us our net operating profit after taxes. And we're gonna add our depreciation of 43,200, which is also the same as the depreciation here, and that's gonna give us our operating cash inflows of 143,280. And we're gonna do the same for year 2, revenue being 3,320,000 minus our expense of 3,130,000, which is going to give us our earning before depreciation, interest, and tax of 190,000 minus our depreciation of 43,200, which is going to give us our earnings before interest and taxes of 146,800, and we're gonna minus our tax of 40%, which is 58,720, and that's going to give us our net operating profit after taxes of 88,080. And we're gonna add our depreciation of 43,200, which is the same depreciation as up here, and that's gonna give us our operating cash inflows of 131,280. And we do the same for year 3, year 4, year 5, and year 6. Final step in estimating the operating cash inflows for a proposed replacement project is to calculate the incremental cash inflow. Incremental operating cash inflows are needed because it shows a change in the operating cash inflows that result from a proposed project. Therefore, here we can see that column 2 represents the amount of operating cash inflows that Powell Corporation will receive if it does not replace the present machine. And column 1 shows that if the proposed machine replaces the present machine, the firm operating cash inflows for each year will be these figures right over here. And column 3 is subtracting the present machine's operating cash inflows by the proposed machine operating cash inflows, which will give you the incremental operating cash inflows for each year, which are these figures over here. So right here, we're gonna take the proposed machine operating cash inflows minus the present machine operating cash inflows, which is going to give you the incremental. And we get these figures for the proposed machine and present machines from table 11.7. Here is the operating cash inflows for the proposed machine, and this is the operating cash inflows for the present machine. So by minusing the proposed by the present, for example, 173,600 minus 143,280 is going to give you an incremental of 30,320 for year 1, and for year 2, 198,560 minus 131,280 is going to give you 67,280 incremental for year 2, and so forth. And that is how you calculate incremental.